Hello everyone, my name is Diya Bansal. So here I will be discussing about types of business loans. What is a bank? A bank is a place that will lend you money if you can prove that you don't need it. A bank is a financial institution that accepts deposits from the public and create a demand deposits while simultaneously making loans, mobilizing save up surplus to deficit spenders. Lending activities can be directly performed by the bank or indirectly through a capital market. So, what are business loans? Business loans are financial instruments that provide funds to businesses for various purposes, including operations, expansions, and equipment purchases. These loans can help companies maintain cash flow and invest in growth opportunities. A business loan is a type of financing used by businesses to cover costs associated with running, operating, and growing their business, such as working capital, equipment purchases, or expansion. These loans are repaid with interest over a set of period and they can be secured or unsecured depending on the borrower's creditworthiness and the lender's requirements. Why do businesses need loans? First, funding expansion and growth. New markets. Loans can help business enter new markets or expand into different geographical areas. Acquisitions and new products or services. Second, purchasing assets and equipment. Equipment loans can help business acquire or upgrade essential equipment, machinery, or technology. Inventory businesses can use loans to purchase inventory and maintain optimal stock levels. Third, real estate loans can be used to purchase or renovate business premises. Third, managing cash flow and operating expenses. Working capital. Loans can provide businesses with the funds needed to cover day-to-day operation expenses such as payroll, rent, and utilities. Cash flow fluctuations. Loans can help businesses bridge cash flow gaps during the slow periods or seasonal fluctuations. Third, emergency expenses. Loans can provide a safety net for unexpected expenses or emergencies. So here we begin with types of loans. First, startup loans. Designed for new businesses with little operating history, they help with initial expenses like inventory, marketing, and hiring. Lenders may require guarantees or collateral. Startup loans are specifically designed for new businesses that lack operating history. They cover initial setup costs, inventory purchases, market expenses, and hiring, often require personal guarantees and collateral. A startup loan is a financial product that helps new businesses get started. It can be used to start a new business or expand an existing one. Features of startup loans. Startup loans may not be backed by assets or cash flows. Startup loans may have higher interest rates. Startup loans may require significant collateral. Startup loans may have specific terms and repayment conditions. Second, term loans. A lump sum loan repaid over a fixed period with regular installments. Used for businesses, expansion, machinery, or long term projects. Interest rates are often fixed with tenures between 1 to 10 years. Features of term loan. Fixed loan amount. Borrowers receive a predetermined sum of money upfront. Fixed term. The loan has specific duration, typically ranging from 1 to 10 years. Third, regular payments. Borrowers repay the loan in regular installments, usually monthly or quarterly. Fourth, fixed interest rate. Interest rates are typically fixed for the duration of the loan, providing predictability in repayment amounts. Fifth, security term loans may require collateral to secure the loan, such as property or equipment. Third, equipment loans, specifically for purchasing equipment or machinery. The equipment itself serves as collateral and the loan term depends on its lifespan. Equipment finance is a secured loan and the equipment in the question is considered as the collateral by the bank. Primarily, banks offer pre-approval to the most borrowers under a equipment finance loan to provide a hassle-free and seamless procedure. Third, another benefit of equipment finance offers flexible repayment options depending on the business, financial budget and the repayment ability. Fourth, working capital loans. A working capital loan is a short-term business loan designed to finance a company's daily operations like payroll, rent, and inventory rather than long-term investments or assets. Here are more detailed explanations. Purpose: working capital loans are used to cover a company's short term operational needs, ensuring they have enough cash on hand to cover daily expenses. Short term nature: these loans typically have shorter repayment periods compared to term loans, often ranging from a few months to a year. Flexibility: they can be used for a variety of short term expenses, including payroll, rent, utilities, etc. Fifth, overdrafts. An overdraft allows businesses to withdraw more money than available in their bank account, up to a specific limit. This loans facility offers flexible access to funds, and interest is only charged on the amount used. It is particularly useful for businesses facing temporary cash flow issues, enabling them to manage supplier payments and other urgent expenses. Types of overdraft: authorized overdrafts are arranged in advance, so there are also known as arranged overdrafts. You agree a limit with your bank and can spend money up to that limit. Second, unauthorized overdrafts. These are also known as unplanned or unarranged overdrafts and happen when you spend more than you have in your bank account without agreeing it in advance. This includes going over the limit of an authorized overdraft. Sixth, invoice financing. Invoice financing, also known as accounts receivable financing, allows businesses to borrow against their unpaid invoices. This provides immediate cash flow while waiting for customer payments. A percentage of the invoice amount is financed upfront, and the loan is repaid once the invoices are settled, helping businesses to maintain operations without delays. Accessing funds: business can obtain a percentage of the invoice value, typically 70 to 95% as a loan or line of credit from a lender. Collateral: the outstanding invoices serve as collateral for the loan, meaning the lender has claim against the invoice value if the business defaults payment. The business repays the loan either when the customer pays the invoice or at a predetermined time. 7. Loan against property. Loan against property involves financing by pledging commercial or residential property as collateral. This type of loan is suitable for businesses looking to purchase new office spaces, refinance debts, or fund significant expenses. LAP offers lower interest rates compared to the unsecured loans and generally comes with longer repayment tenure. 8. Personal loans. Personal loans are often utilized by business owners for their operations, especially in situations where business loans may not be feasible. These loans are typically unsecured, meaning they do not require collateral, which can result in higher interest rates. They provide quick access to funds for urgent business needs. Ninth, credit card loans. Credit card loans are used by businesses for small emergency expenses and are characterized by high interest rates. These loans provide quick access to cash, making them a convenient option for businesses facing immediate financial needs. However, the cost can add up quickly if not managed properly. This is the flowchart representing requirements for getting term loans. So here are some common requirements that business typically need to fulfill when applying for a term loan. First, business registration. The business should be legally registered entity such as sole proprietorship, partnership, private limited company or limited liability partnership. The registration documents such as certificate of incorporation or partnership deed will be required. Second, business vintage. Lenders generally prefer businesses to have a minimum operational history of at least 3 years. However, some lenders may consider providing term loans to business with a shorter operational history. Third, financial documents. Businesses are usually required to provide financial documents to demonstrate their financial health and repayment capacity. These documents typically include auditing financial statements such as profit and loss statement, balance sheet, cash flow statement for past 2 to 3 years. Fourth, bank statements. Lenders often request bank statements for the business accounts for the past 6 to 12 months. These statements help assess the cash flow, transaction history, and repayment behavior of the business. Fifth, turnover and profitability. Lenders consider the business's turnover and profitability to evaluate its financial performance and repayment capacity. Documents such as Goods and service tax returns, income tax returns, and sales invoices may be required to verify the business's revenue and generation and profitability. Sixth, credit worthiness. The credit history and credit worthiness of the business and its promoters play a crucial role in the loan approval process. Lenders typically check the credit score, credit report, and repayment track record to assess the borrower's credit worthiness. 7. Collateral or security. Depending on the loan amount, the lender's policies, term loans may require collateral or security. This could include assets such as property, machinery, inventory, or accounts receivable. However, some lenders also provide unsecured term loans based on borrower's credit worthiness. 8. Business plan. Lenders may request a comprehensive business plan that outlines the purpose of the loan, the utilization of funds, and the projected financial performance of the business. So, this flow chart represents requirements for getting working capital loan. So, at the end, I would like to conclude with understanding the different types of businesses loans is vital for business owners seeking financial options. Each loan type serves specific needs from startup capital to managing day-to-day expenses, enabling business to thrive even in challenging times. So, this was all about types of business loans. Thank you.